Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, January 18th, 5:43 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, uptrend with caution. The with caution definitely reared its head today as a healthy pullback yesterday at the beginning of the day looked like it was the pause that refreshes, and then an hour into the session, the market just did an absolute about face and sold straight down for multiple hours, no bids anywhere. It was basically just the opposite of 2 days ago when we trended higher. This was just a case of trending lower, undid a lot of the good that had gone on in the market over the last week and a half, 2 weeks, and we'll get into all of that when we review the charts. You can see over on the trend gauge here, market leaders relative to the indexes, I'd say they're still holding up pretty well. Only two stocks in the 2121 list broke down today, but a lot of them got extended last Friday, and they're pulling back with normal pullbacks. It's the indexes, and you can't necessarily blame the big cap stocks in the indexes today. But oddly, what you can blame is the more defensive sectors, as XLP staples and XLU utilities led the way down. You'd think in a questionable market, that's normally where money gets stashed, but money was very clearly coming out of those two sectors today. And with the Dow lagging over the past 2 weeks, it broke the 21 and 50-day moving average today. So some things you wouldn't expect from a market that's trying to hold up, but the market always seeks to fool the masses. And like I said, we'll look at the charts here and we'll break it down shortly. So a little bit downgrade on the 21 and the 50-day moving average as the Dow broke below there. So we're still in an uptrend as for the five indexes holding up there. Long-term neutral with the S&P breaking below the 200-day moving average and the NASDAQ 100 never getting above it. However, the equal cap, uh, the um, the evenly weighted versions of those indexes still above the 200-day moving average. So what just happened? Nothing good just happened. Gap up, negative reversal, broke the 200-day moving average on the S&P. We'll look at the different time frames on the charts, and you'll see the selling momentarily here. The G6 down 1.5% on the day, S&P down 1.56, NASDAQ 100 down 1.3, Dow down 1.8. Even worse than this is a dividend ETF that we owned, SDY, down 1.95, and our stop was hit on that today. Mid caps down 1.25, Russell down 1.6, Global Diversified 60/40 stock and bond down 0.33. This led because bonds look like money is flowing into bonds today out of defensive sectors. Maybe the market feels that they can get 3-4% out of a bond. Why worry about getting a higher dividend and the risk in defensive sectors? That would be my explanation for this. But it down only 0.33% today. In-house GROTECTION down 1.12%. The lagging Dow and SDY uh, hit us. We'll go through the portfolio. We added one position today, and but our beta ended up going out less than when it came in, with us breaking the 200-day moving average on the S&P and the 21 and the 50 on the Dow. So let's get into it. What we do at Revere is active management, taking a look at the market and how strong or weak it is relative to its trend. We mark its trend on highs, lows, support lines, moving averages, uh, downtrend lines, uptrend lines, and we get various signals. And this tells us whether to be heavy in the market, even with the market weight, or overweight with the market. And we get to a maximum defensive position when this chart, when we get below the 200-day moving average, because this is a chart of the prior 13 bear markets, including the one that we're trying to recover from right now that made its low back in October. But for the third time now, poked its head above the 200-day moving average and failed again. And it's the big losses below the 200-day moving average that you need to be concerned about, and that's what we protect clients against. You take care of the big drawdowns, and the returns will take care of themselves when the market gets back to even. Sometimes you have brief, harsh sell-offs like we did with COVID, down 35%, this 3-month in 2018 down 20%, or you have grinding bear markets, which is what we're having now, what we had back in 2000 to 2009, what we had in, I'm sorry, 2000 to 2002 with the bursting of the tech bubble, in 2007 to 2009 with the financial crisis and the bursting of the real estate bubble. But we we avoid these, and we know we will have small losses below the 200-day moving average, but we won't have massive losses. And if you're interested in this approach, give us a shout. You can email me, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com, or phone 855 Real Wealth. That's 855-732-5932. So back here to the S&P 500, first of all, let's go to a 15-minute chart. Uh, this was the trend up I was talking about on the 13th, last Friday, where we gapped down, but it was really a best case scenario for the bulls, just buyers all day Friday into the close, into the 3-day weekend. Then yesterday, gap up, harsh sell off in the morning, but then just kind of going sideways, no real harm done. Then this morning, another gap up, and just held it tight sideways for the first hour, hour and 15 minutes. And then it was like somebody pulled the plug. You can see here on the 5-minute chart, this is called what we call a frozen slope. It's just on the 5-minute chart, lower lows, lower highs, constantly down. We went from 40.14 all the way down to 39.39, from a 0.5% up to 1.5% down. A little bit of a rally, but this is what I didn't like about the rally. Every time, well, here we paused on the way down around 39.50, which was our prior support level. We broke it, tried to get back above it, went lower. Tried to get back above it uh, early afternoon, and every time we ran into 39.50, it's like that support area, that, or what used to be a support area, had flipped to resistance. This is the biggest concerning thing for me, is the multiple times we tried to get back above 39.50 today, and we couldn't, and then just failing into the close, closing near the lows of the day. So really not good from that standpoint. If you come back and look at it from a bigger picture, the low to the high, if you want to draw fibs, we haven't retraced 50% of the move. We would have to go down to 39.09 from this low part of the range to the high that occurred yesterday. Uh, Retracing 50% of any move is completely normal. It's not cause for concern, but you never like breaking multiple support areas. We certainly don't like going above and breaking the 200-day moving average, because we know we're at risk to big losses under the 200-day, because this is where all bear markets have occurred. So we're sitting right now on basically the 50 and the 200-day moving average. So from a moving average standpoint, we need to see if that's going to provide support. If we go back to a 60-minute chart and take a look at horizontal support, 3900 is the area. Really, I talked about this a few weeks ago, this 3890 to 3920, this range here. Where we broke it, tried to get back above it. That's a key area. So it's really about 1% wide, and we're just barely above it right now. Let's call it 3,900 to split the middle. You can see we broke below 3,900 this day. This is when we closed that day on the 10th. Overnight, I mentioned how we needed to hold that 3880 overnight. We did. We continued to rally for a couple of days, gap down, rally, gap up, fail, gap up, fail. This is bear market action. Uh, but honestly, it has been a decent run off the low, and we haven't given back half of it. So that alone, that's a check in the positive column. But again, that break of 39.50 is a check in the negative column, and ultimately, um, there'll be more checks on one side than there will on the other side. and that's what will dictate the market reinstating this rally off the lows or breaking back down into this big area of chop that was 3764 up to 3900. So worst case 3900, really 3880-ish is where we don't want to go below. And this is kind of when I issued that warning on 110 that we didn't want to break below this low of the day, 3877 on the downside. That's really the area that is the top of this range that we don't want to get below. Otherwise, we're just back in the chop and it's a failed breakout. And breaking below this 3764 opens us up to all kind of moves lower because there really is no resistance, or sorry, no support down to 3,500 if we break below that 3764 level. So multiple levels. The market took a step back today. We pulled back a little bit in our positions. I'll talk about that when we go through the tail of the tape. But not a whole lot of good today. Um, Nothing really I can point to. Actually, I will point to 10 stocks that finished green that were leaders that seemed unaffected. But if you hold on to those stocks too long and the market's going lower, it'll get them, trust me. So the decision is whether to sell into strength or try to hold for a little bit of a bigger gain, or maybe split the difference, take some profits and set a stop on on the rest, so that you don't lose money. And that's what we ended up doing today with our SDY and DIA positions. We got out break even on them, but they lagged the S&P since we took them. I mean, their break even, the S&P still up 2% since we bought them. So um, the very very interesting to see the supposed defensive parts of the market that are lagging during a pullback. Let's go to the Nasdaq 100 now. Blame the big caps today. This was down 1.3, actually the best of the five major indexes, and the equal weight down 1.5. Uh, Came back, paused at the 50-day moving average, so that's a good stopping place for it. Oh, something else I need to point out, the stochastics are rolling over at the top. And let's just go right into the Dow now. And this is what we don't want them to look like, but we're in step one. Step two is a break below over bought and a break of the moving average. And when you see the black line come down through the blue line, us getting out at break even, breaking the 21 and the 50 and the stochastic rolling over, made sense to just pull the plug on this, as this has become the weaker index. I've been pointing that out for 2 weeks on a relative strength basis. And really, a lot of it is just because some higher price stocks in there are underperforming. And when they underperform relative to what's going on with the rest of the index, that's going to drag the Dow lower. When they're leading, those big stocks, those high price stocks are leading, the Dow will outperform. When they're lagging, it'll underperform. Let's look at a 60-minute chart. If you're looking for some good news here, it really is sitting kind of right on the top of this 33.3 to 33.5 area here. But this is back in the slop that we haven't gotten into on any of the other indexes. The Dow's the first one to completely fail its breakout at 33.5 here, above this trading range. And let's just reference the S&P. You can see again, still above that area, and the NASDAQ 100 on the 60-minute chart, uh, still well above that area. 275 and then 270 are the key areas for the NASDAQ 100. Let's go right into mid caps and then small caps. We'll start with the 60-minute chart there. You can see how far this is still above that 450 level. That was a big resistance level on the MDY that we broke above. Will it act as support when we come back into it? We've now got the 21 and the 50-day moving averages above that 450 level. We'll see what happens if we get back there, but ominously, we've got the stochastic starting to roll over. Sometimes you just chop like this, the way we did here, and the market's still trending higher while that's happening. But as you can see with the Dow, that's not what happened. But again, with the Dow, I pointed out it's a handful of stocks higher priced at the top of it. Here's the small caps rolling over also. Still above all the moving averages, though, above the 8, the 21, the 200, and the 50. And if you go to the 60-minute chart, still well above this 178, 170, or to 180-ish breakout area from this multi-week base that we put in on all of the indexes. Let's go to RSP, equal weighted S&P. Broke the 8, but still above the 21, the 50, and the 200 and the breakout area, which in this case is 143 to 144. It's never just one number. It's always a range. You can't just call it to the penny and set a stop below a penny below that, because you'll get taken out. And then QQEW, equal weighted NASDAQ 100, still above the breakout area there. In this case, we'll call it 91. So those are the 5 major indexes. Let's go to the rest of the indexes that we track every night. Here's the VIX. Basically, this is Friday is looking like a false breakdown here. Still below the 21-day moving average with the declining slope, and the 50-day moving average. But again, this 20 area is where we've failed to continue going lower, going all the way back to this time last year. Normal spot for it to bounce up. Also, in that case, a normal spot for the market to come off a bit. And you can see the stochastic bounced right at the over sold level and is heading back up. How about the dollar? Dollar started out today. There was news pre-market, and the markets reacted very favorably to it. And we, like I said, we held up that first hour, and the dollar gapped down. But look at a 5-minute chart on the dollar. That gap down just clawed its way back till midday and then went sideways. Let's look at a 60-minute chart on the dollar. And you can see how we're at lower lows here, and this has been weaker relative to what all the indexes were doing. If this was completely in sync with the indexes, it would look the opposite of what we just showed on those basing and breakout areas. But it's further below there, which would lead to some strength, you would think. But we certainly didn't get that strength today. Actually, here it is. It's back here where it's not acting in concert. And really, let's take a look at SH, this is the complete inverse of what it's acting like. So you can see it's really in this area here when it became disconnected back at the beginning to the middle of December, when it stopped working in sync with what the indexes were doing. But as the dollar strengthened today, very clearly the market was coming off. So we do need to keep an eye on the dollar. Let's go from the dollar right into gold and silver, because of the relationship that we know is a contrary relationship with gold and the dollar. Here's gold gapped up and had a negative reversal, similar, complete opposite to the way gold gapped down and had a positive reversal. Here's your 60-minute chart on gold, and this is the one that is completely opposite to what the dollar is doing. So precious metals and the dollar very much still in sync. Here's the silver chart. We've been pointing out the failed breakout in silver here, and how it's back in the chop range, down 2% today and breaking the 21. So at the bottom of the range now, you can see a handle being put in this cup and handle pattern on silver. How about gold and silver stocks? They were weak yesterday, weak again today. Again, same thing, they gapped up. Look at the 60-minute chart here of GDX. Gap up, close at the low. 2 negative days on gold stocks, but still holding the breakout, which you can see here is around the 3060 level. Excuse me. Back to the daily chart for here, broke below the 8, but still trending above the 21, above the 50, and the 50 did have a cross up through the declining 200-day moving average on gold. All right, let's get to bonds now. First, the broad bond index moves higher above its 200-day moving average. This is a first for bonds in quite a long time, over a year. Let's go to a weekly chart and see where the 40-week moving average is on. Look at this, all the way up here. We're talking November, December of 2021. Last time bonds, they really clung to the 200-day moving average for 6 months. before breaking lower. Now bonds back above the 200-day moving average. That's a change of character if it holds. So we will be paying a lot of attention to that black line with bonds getting back above it. BND, maybe people were too soon to bury the 60/40 portfolio. JNK, junk bonds, also up today, 4 closes above the 200-day moving average now. That is a good sign for stocks. It says that there's no fear in the credit markets because junk bonds sell off decisively when there is. That's always a sign we're looking out for. LQD is corporate bonds, also up today. This tells me, again, continuing money flowing into bonds out of stocks. Um, with the price bid up, the yield drops. There was more, when we go to the tail of the tape, we'll talk about the news that led to this reaction today in the bonds and initially to stocks gapping up before reversing. And then finally, TLT, this is the 30-year, not quite above the 200-day moving average yet. Let's go to the yields themselves. 0TNX, this is the 10-year yield, making lows going back to September of last year, still above the 200-day moving average. And TYX, which is the 30-year, it hasn't broken the lows from a couple of weeks ago, still above the 200-day moving average. We also got the 5-year. Let's see what it's doing. Made new recent lows. So the shorter end making new lows before the long end is, and we're sitting right on the 200-day moving average from a yield standpoint. And we'll check out Bitcoin because it has attempted to reassert itself and still hasn't filled this gap. This is a weekend, a 3-day weekend gap, though, where it's very strong. Down today, 3.4%. Let's see if this gap gets filled in Bitcoin. So those are the major indexes. Let's go to the tail of the tape now. The stochastics have gotten worse over the last 2 days in the indexes, and especially with the Dow being an outright sell now on the stochastic. VIX up 5%, still at the low end with it being 2034. Fear and greed dropped 8 to 57. Bull case, bear case is battling it out right now. So here's the news pre-market. PPI came in down 0.5%. So this is inflation on the producer side. For a while, the spread between the producer and the consumer was negative, which means producers were losing money and having negative spreads, which affects their margins. But this was seemingly great news on the inflation front, down 0.5% versus down 0.1% expected. And that turned, as I said, the CPI PPI spread to positive for the first time in 2 years. Then weak retail sales came in. Between the two of these, this is what led to this gap up of 0.35% this morning. As everything that the stock market would want for Jay Powell to pause on rates, these are two more pieces of data that would have helped that. We had 4 Fed speakers today, and they were jawboning, and every time they opened their mouth, the market seemed to go lower. The highlight was Bullard saying that he thinks the soft landing chances have increased, but he still wants 50 basis points at the next meeting, even though there's over 90% odds now that it's going to be 25 basis points. And the weak retail sales uh, is pointing to again a slowing economy, which is what you want in order for them to stop raising interest rates. This is actually a -1 now on the ADMA with the close below it. And let's go back to the S&P, see how far we are above the 21 on the S&P 500 and 0.4% below it. So 8th day up above the 21-day moving average, first day below it, below the ADMA. You know, if you're going to break the 21 EMA, the first thing that has to happen is you're going to break the ADMA. This is enough to tell me to put the brakes on new buys until we see what happens. I really like to have the short term, the ultra short term trend, have the direction of the moving average be pointing up and it be above it. And we're going to down 1 on the day count now from up 6 with one consolidation day, with today very clearly being a distribution day. in the market. So coming into today, expectations were positive from the standpoint that we're on a follow through day and we're off the bottom, rallying nicely above the 200-day. Neutral from the standpoint that, well, we've gone up 6 days and had one day of a consolidation. Little nice gentle consolidation would help. We didn't get a gentle consolidation. We got that harsh negative reversal. As I said, closing at the lows. The support and resistance one and two both violated, as well as resistance where we got back above it and failed. The high today was 40.14. As I said, really not a lot of good today. Not anything good, frankly, to point to. Tight first hour, 2.5 hours down, huge negative reversal, 1.5%, 1.9% off the high. Rally tried to get back above 39.50, failed. 39.27 was the low of the day. Um, the only the only thing green was bond prices, which means yields are down. Relative strength was at least shown by semiconductors, builders, and biotech. Dollar started down, closed flat. 11 out of 11 S&P sectors negative, the worst being oil services, which had been leading, banks, which had a great positive reversal last Friday after the initial bank reports came out, but has given up most of that gain now. And then staples and utilities, the worst of the 11, and KWeb, that's China, also pulling back. So a lot of things that led people locking profits in. Here's our focus list. We'll go through all these charts. These are the 10 included in here is 10 that were positive on the day. Very often the true strength is revealed in the pullback because what holds up means that the holders are strong. They don't want to give it up. And we will go through. So the portfolio changes that we did today. The first one was we bought Chewy. Chewy had this was an interesting day on Chewy. Chewy had a big gap down on a downgrade, and immediately within 15 minutes, buyers came into it. This is something that got on our list yesterday. Well, it's been on our list for a while. Yesterday, it tried to break out. So when I got that alert, it really started paying attention to it. And then the recovery, we got above that and bought a 2% position on that today on the strength of the recovery at 44. So on the 5-minute chart, it was when it pulled back to 44 here after topping at 44.50. This is where we got in. Actually, no, it was we bought half here before 44, and then the other half up here. The average was 44 of the two buys, but then you can see along with the market, it started giving way, and this initial gap down that was bought was given up. So overall on the chart, still holding the 21-day moving average. In fact, sitting on the 80 MA. This has had a real nice run with volume off the lows, and they're like I said, they're going to be profitable this year for the first time. But um, I see the stochastic hooking over, so we may be getting stopped on this. Chewy, SDY, this was that other dividend ETF that I talked about that we were in, was riding the 8 higher until today. Broke the 8, the 21, and the 50. Stochastic sell signal, very similar to the Dow. Relative strength. It's like I said, we bought it when we came above here, above the 21 and the 50, and it lagged the S&P the entire time. The S&P has been outperforming it. You can tell that by the relative strength line. So we sold it for break even when we broke the 21 and the 50. Very similar to the Dow. We had two buys in the Dow. We sold one break even and one for like a, I don't know, 3/4% gain on a 5% position. Very small gain. The net was basically even. And then we bought Chewy. So portfolio came in at 0.7, going out at 0.64. Bottom line, nothing good. Gap and crap failed to hold the 200-day moving average. Down below here, what's our next level down? The 50-day moving average, the 150-day moving average, the 100-day moving average, the May, June, July, September support resistance. There's a big area down here at 39.07. And if we give all of these averages up, like I said, we've got a problem because there's really no support all the way down to the prior lows. So let's go through the rest of the charts now that are in the focus list. We'll start off with what we still own, and that's XBI Biotech. Has been a leader, has pulled back the last couple of days, still sitting above the 80 MA, the breakout level here was 84, 85-ish, and we're right back in that area. So back to the pivot, you basically could say, and the stochastic hooked over. XBI, JPM, really liked this when we bought it on that positive reaction that we saw in all the bank stocks. But Goldman Sachs started to undo it yesterday and then reversed all the way down to the 21. We're down about 4% on this on a 3% position. So down 0.12 versus the overall portfolio. And we'll see how things react tomorrow. Stops in place, as always, to keep the losses small. Something that was one of the 10 that were up today, AEHR, but it was up more, above 30, gave back a good bit. Very clearly a leader from a relative strength standpoint and a price standpoint and a story standpoint. But again, you always have to deal with the M in market. Now, two brokers that reported earnings today. The first one was Schwab, disappointed, gap down, but closed near the high of the day. Look at the 5-minute range on this. Big gap down. Uh, Again, closed at the high range of the day, broke the 21. This is one of the two in the 21 over 21 that failed, but it did reclaim the 50-day moving average. Very often, gaps down like this that finish with a hammer, it puts in the low and the sellers are done. But we don't. We'll see what Price has to say about that. And then IBKR, which initially had a huge gap up and then immediately sold off big time from 83.50 all the way down to 76 in less than 30 minutes on heavy volume. But again, sometimes all the sellers, these are inflection point days. All it did was come back to the 21, the 8, and the 50 and bounce there, and then have a nice close to the day and actually near the pivot on this double bottom base that it's forming. So all is not lost. You can see there's the double bottom, 80, 85 is the pivot, closed right above that. We'll see what happens in the next couple of days. Big volume, 381%. That was big selling volume and big buying volume, but uh, the low of the day is the reference point for any position that would be taken on this. Okay, now the remaining 1, 2, 3, 4, 5, so the remaining 8 stocks that finished positive on the day. We'll start with MDGL. Biotech, big gap up, crossed 300 today, but pulled back, still respecting the ADMA, very clearly a leader as it reported that phase 3 data. RVNC, another biotech. This is in the health and beauty, a challenge to Botox, putting in a handle here after this massive 50%, 54% move up on 724% volume, pulled back nicely, hasn't even touched the ADMA. Good stuff there, continues to show strength. RV, that was RVNC. Next up, SGML. Below average volume, but a good price action today, and it got back above the 21 last week and now above the 21 and the 50. This is a former leader. You can tell by the price action back here. Had the power from the pivot back in August. Nice run up from 20 to 40, now forming this double bottom base. PI, which we owned and got stopped out of back here, having a really nice day and a breakout that held. You see, I've got my alert set there to see if it fails, but can't complain about the action in PI today. MedP, another medical stock, former leader that put in a base, this long flat base here, relative strength at a new high, up 1.6% on the day, up near the top of its range. MBLY also acted like there was no correction at all today, up 6% on the day. It was up almost 10% and bounced at the 50-day moving average once this appeared on the chart. So that's a reference point for a stop, and it's back above the 8 and the 21 now. Ulta has been acting good for a while, and new highs at 500, riding the ADMA higher. Good stuff there. And STM, they're also involved in silicon carbide, semiconductor stop, 7, 8 consecutive days up on this relative strength. Fantastic. Broke out above 40, and it's holding it. Should be on any leaders list. That's going to wrap it. As always, like to hear from you. You know the contact info, Don at revereasset.com. Phone is 855 Real Wealth. That's 855-732-5932. Entries back into the market do not come without some risk, and that's what we saw today, down 1.12%. Tight stops relative to the moving averages. And then if we really, the market doesn't get into trouble unless you break below this support area here. But we like it to respect the moving averages, but we also have to respect the break of that 3,900 area, which was very key. Last look on the 60-minute chart here. Here's a 3,900 area at the worst, 38.77. So again, that's going to wrap it. Remember, it's not how much you make in the market, it's how much of that you can keep. And with that, I will wrap up Wednesday, January 18th. This is Don Vandenbord for Revere Asset Management, telling it like it is. Thanks for listening and have a great day.